Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. If my sound, if my voice sounds, a little bit weird today, is because, subhanAllah, the whole family and I have been basically COVID positive, but alhamdulillah, we are good now. Everything is fine. The children are doing well, the missus is doing well, I'm okay, alhamdulillah. As you can see, I'm actually recording a video, so I must be doing well. But my voice is still, I think, all over the place. So just apologies in advance. The other thing I want to talk about is just that there's a lot of negative in the market right now, especially just the last week and this week. And we don't know how long this is going to continue. So I just want to talk about this before we get started. Because today I'm going to talk about 5 different stocks that could potentially be a great addition to your portfolio. And I'm going to basically give you the details in a second. But before we do that, I just want to talk about generally what's happening in the stock market. So basically yesterday, even last week, we've seen a weird pattern where the stocks were up for, just almost 1%, whatever. And then towards the end of the day, it was all massive selling. A lot of people have now basically talking about obviously the interest rates going up and blah, blah, blah. And also the Fed in the US obviously might come out this Wednesday and talk about it. And because of that pressure, because of the earnings reports not going well. And then obviously if the Fed starts talking about obviously anything negative, everyone is worried about that something might happen and the stocks might crash, blah, blah, blah. As always, I just want people to start ignoring this noise, because it genuinely is just a noise, okay? If you own great companies, especially if you own blue chip companies that pay dividends or they've been around for a long time, I'm talking about the Microsoft, I'm talking about the Adobes and all of these companies, especially the tech sector, because that is the one that has been selling really fast in the last few days. But weirdly, yesterday, at one point, Adobe was down, I think, above almost 5%. Okay, and then it went up almost 4% at the end of the day, and it was just really very strange. So in those situations, what should you do? I'll tell you what I did. Okay, I had 2 shares of Adobe, and then yesterday when that happened, it went down 5%, I actually bought 1.4 shares of Adobe. Okay, I bought more PPG, I bought more VF, and I've added to my portfolio because there was a couple of stocks that actually went down 2-3% and so on. Okay, I bought more the other day of 3am. So I am using this dip, or whatever you want to call it, as an opportunity to add to my overall portfolio. Okay, and I've always been transparent. I'm going to be transparent even if it goes down 20%, 30%. As you can see, yesterday was a massive day. It just went down, up kind of thing, and then at the end it finished to almost 41,700. Okay, where it is at the moment. So it's just a strange market right now. I think this is going to continue at least until March. By March, then we will know what the Fed is doing and how much basically they're raising the interest and whatever. Once after that, I think the markets will stabilize. But for now, just keep doing what you're doing. If you've got great companies that you believe in, just hold on to them. The other thing I just want to mention quickly is, if you're enjoying this kind of content, okay, it takes a lot of time to actually prepare these things, put together these things. So I really would appreciate if you just can press the like button. If we can get to 50 for this video, that would be amazing, okay? So just press the like button if you're enjoying this kind of content, transparent. All I'm doing, again, as I've always said to you guys, is just to share my journey. And obviously I'm not a financial advisor, I'm just telling you what I'm doing, and I'm actually showing you exactly every week, inshallah. So whether it's up day, down day, whatever it is, I'm going to share this journey with you, inshallah. So if you like that, just press that like button. That's all I asked, okay? So the first stock that we're going to look at is a company called Corning. Corning basically is a company that develops glass, okay, and the LED glasses and OLED glasses, and these are the glasses that are used in television, notebooks, computers, desktop monitors, tablets, and handheld devices. So this is not the kind of company that you hear about, but is one of those companies that are out there that is actually doing basically almost, if the phone that you own, the TV that you watch is probably has a glass that was developed by Corning. So it's in the tech sector, currently trading at $35 per share. It has a PE of 37, which is quite high in my opinion at the moment. Okay, but I'll show you what the analysts think. Market cap of almost $30 billion, annual dividend, which is amazing, 2.74%, 5-year growth rate of 13%, which is absolutely brilliant. Dividend growth years for 10 years. They've been paying that, growing that dividend for over 10 years. They have a payout ratio of only 46%, dividend safety of 77%, and then you've got free cash flow of $1.7 billion. And that's amazing because this is the money that they can use to pay you dividend, to buy back shares, to reinvest in the company, and all sorts of things. It has a beta which is slightly higher than the market at the moment, okay, which is just slightly above high. You tend to get companies, these type of companies just normally are above 1 anyway. Profit margin, normally I say about 15%, but this one is about 12.15%, which is fine. Return on equity, 13%. And then future growth, okay, the expectation is that this business will grow about 17% in the coming year. And then according to Simply Wall Street, it's undervalued 22% at the moment. According to Morningstar, it's fairly valued and it's $40 per share, whereas target price for this, according to Simply Wall Street, is $45, and it's a buy at the moment. So this is the first company, and this is the kind of companies that actually no one likes to talk about. Again, they're paying a really good dividend. Their payout ratio is quite low. They're in a very good business. The OLED and the LEDs and all of that technology side of things is absolutely brilliant. You don't hear many people talking about it. This is the kind of companies that you potentially could own and basically in your portfolio and just forget about it. Just buy and forget. So again, the way the markets are going, God knows what's going to happen, but this could potentially be a great addition. I don't own the business stocks in this company yet, but it's something that I'm looking into, inshallah, in the long run. So at the moment, I don't own them, but I like their business model because of where they are, okay? Because a lot of the businesses that actually, any company that, including Apple, that basically has their own tablets and mobile phones or whatever, uses coding, and if that's a very good market, but the PE is very high. Although it's a buy and it's undervalued at the moment, this PE is quite high. But remember, the technology PEs are quite high at the moment. So I might wait until maybe it comes back down to mid-20s, but that might never happen. Again, by the way, when we use PE, we use it to compare it with other companies. You can't just use it as standard alone. So you have to look at other businesses as well that are very, very similar to this business, and then see if it's above the market or below the market, and so on. Okay, so the next company is a great company that you know about, Unilever. It's been on the news the last few days if you haven't heard about it. So let's get to the news first, because that is the stock has been down for a long time, and then last couple of days is just a little bit of news just came up. Okay, and the first one is this one here. Okay, they were planning to spend $50 billion on pounds in buying JSK unit. Okay, and that was the consumer business side of it, and that's basically what they wanted to do. But then JSK said absolutely no chance. And for that reason, the stock went down quite a bit. And then I bought more shares. So I'll share with you quickly. There. I bought 5 more shares since that day. And then the stock went back again. Today, they're on the news. Okay. The Unilever took up 15,000 jobs. 1,500 jobs in management shake-up. So again, this is a very good news. The fact that they're actually trying to change the business, not the business model, but trying to make it the management side of it a bit more effective. And the final thing I want to talk about is just this thing here. An activist, hedge fund guy, who basically did similar thing with Procter & Gamble, is actually now buying shares in Unilever. What these guys do is they buy basically massive shares in this business. They then try to influence the business. So they will say, you have to do this, you have to do this, and they can get rid of the CEOs and things like that. So basically, for that reason, I think yesterday went up almost to 7% or 6% or whatever it was, because at one point, okay, I was down almost, I think, over £200. But because of what happened yesterday, it's actually bounced back. So we'll see how that one goes. It will be interesting to see if any of these news materializes or becomes the truth. To be honest with you, I wasn't happy with the $50 billion bid to buy JSK consumer business, because that is just where are they going to get the money from? They must be basically getting debt to do that, and I'm not happy with that. So we'll see what happens anyway. I'm just going to keep my eyes on this business, but for now it's a great business to own. I actually like the business model. I love the consumer staples because they're very stable business, even though when the stock market was actually crashing and going down, whatever. I think yesterday at one point it was Procter & Gamble, another business that were basically up. Everything else was down, and I mean genuinely everything else was down. Procter & Gamble and another business were just up. So that's the consumer side of it. I like it. Okay, so currently it's trading at £39 per share. P is just about 20. Market cap of $100 billion. Annual dividends almost about 4% at the moment. 5-year growth rate of just 6%, and they don't increase their every year. So it's just like 1 year, to be honest. Payout ratio slightly high, 82. We want 60s or just below that, which is good. But at the moment it's a little bit high. That's why I'm watching this generally, because to be honest, they're not growing their business that fast, and at the same time they have quite a bit of a debt. And then on top of that, to buy another business and get into more debt, I was a bit worried about that. So hopefully we'll see what happens with that side of things. But dividend safety, they've got about 75%, which is very good. They've got $7.5 billion in the bank, and the beta, this is what I was saying, they're not very volatile at all. Okay, so only 0.27. Profit margin of 10% or almost 11%. Return on equity about almost 47%, and then future growth of about 7%. That's quite high for consumer staples. Okay, so that's what's been expected. Now, according to Simply Wall Street, is undervalued at the moment, and the target price is $46.90, which is fine. Okay, I think if it gets to that point, I will be in the positive. And then it's a buy, and according to Morningstar, is 16% discounted and is 43. So they both agree it's actually undervalued at the moment. And let's just hope that they don't buy this other business and they reduce their debt instead of buying other business, and that will be very good for all of us, because you get that dividend. It's growing a little bit. It's a very stable business, and I like their business model, because this is the kind of products that we need on daily basis. So it's not going to go away, and that's why I like this. Okay, right. So the next company is a company that you all know. You'll probably be surprised to find out Microsoft in this list, but they are undervalued at the moment, and I'll show you in a second. This company currently has a PE of 33, quite high, but the market is just around, the tech companies are around that at the moment. Market cap of $2.223 trillion. That is crazy. They pay small dividend. I don't really, even if they didn't pay any dividend, I will still own this company. They're fine. 5-year growth rate of 9%. Dividend growth years and about 15%, and payout of 27%, which is really, really low. And then dividend safety of 99. Obviously it would be 99%, because look at this free cash flow here, $60 billion. And this is one of the reasons why they basically buying Activision Blizzard. They have cash, $130 billion in cash. But this is just the free cash flow that they can just reinvest in the business and all of that stuff, right? Beta, not even bad, as basically according to Yahoo Finance, okay, 0.86. So it's not as volatile as the rest of the IT or technology companies. Profit margin of 38.5, and return on equity of almost 50%. Future growth, not about 10%. I'm not sure how true this is, but it's fine. 10%, I'll take that from Microsoft. And then you've got, it's undervalued at the moment, according to Simply Wall Street, about 25%. Price target of 398 and currently trading 296. So it's almost 100. You got upside almost $100 or whatever, right? And that is a buy. According to Morningstar, it's only undervalued about 14%. And then you've got $345 per share. That's what they predicted. So there's a little bit, it's a slight bit difference between the prediction, the target price for the year. But again, that's massive compared to where it is right now. Okay, and this is one of the reasons I'm planning to add to it, even though it's one of my biggest holdings at the moment. Okay, I've got £3,564 in that stock, and I think there must be, there you go. So about 8% is the top basically holdings in my overall portfolio. Right, the fourth business that we're going to talk about, or the stock that we're going to talk about, is Visa. I'm sure you know what Visa is. Current price of $201 per share. It went down quite a bit yesterday and bounced back again. P 43, very, very high at the moment. But again, it's the same when it comes to PE. You have to look at the sector instead of just looking at it and compare it with MasterCard and Visa, the what is it called, American Express, and so on. Okay, the market cap is $447 billion, annual dividend of 0.73, 5-year growth rate of 18%, and then you've got dividend growth rate for years, 13 years in a row. They've grown that dividend, which is absolutely amazing, and the fact that they're growing it by 18% over the last 5 years, that's absolutely amazing. Payout ratio of 23%, dividend safety 100%, because they have $14.5 billion in the bank to pay, and then they've not that volatile. Profit margin of 51%, return on equity of 33.36%, and future growth of 13.60%. Now, that's really good for Visa. Okay, and the fact that return on equity and return profit margins, basically what this means is the business takes your money and obviously reinvests in the business, and basically they are basically how effective the management is using your money. That's what it means in here, 33%. Okay, and then you've got profit margins of 51%, which is absolutely amazing, and future growth of 13%. So this is one of the reasons why people are willing to pay more for this type of business, because even though the PE is quite high, this is the reason. Okay, because of that growth, because of the return on equity and profit margins and all of that stuff. It's undervalued at the moment, almost 16%, according to Simply Wall Street, and target price of $244 per share. It's a buy at the moment. Morningstar is fair valued and $221, but currently trading $20 less than where it should be according to Morningstar. So again, another undervalued business, another great business, and this is the type of business that's not going to go away, despite what Amazon has done recently. Visa is not going away. Every transaction that you make somehow, basically, Visa has something to do with it. Okay, so this is the type of business I absolutely love, because it's just on your face. It's not like, for example, like if we look back to all the companies that we looked at, Connie is probably the only one I will say so far that is not on your face kind of thing, although you're watching a lot of the TVs and all of that stuff, right? But they're not too consumer to consumer or kind of business, right? So business to consumer kind of thing. So this company, every time you go to the shopping center, you'll find a product that this company sells. Every time you go to, the computers that we use will have this kind of Microsoft products somehow. And then you look at Visa, okay, it's definitely somewhere in your pocket. Okay, and then the final company that we're going to look at is Medtronics. This is probably one of the ones that hopefully none of us would ever need, inshallah, because they are involved in they create the medical devices basically for diabetes and things like that, cardiovasculars and so on. So yeah, they are this really undervalued at the moment. Great company. I've done a video before. If you're interested, you look into that. But the healthcare and current share price of $104 per share, PE about 30, market cap of 141, almost $142 billion, and then the annual dividend yield was 2.4%, and the 5-year growth rate of 9%. Dividend, basically they have been paying their dividend 43 years. Now this is a dividend aristocrat. So dividend aristocrats are companies that have paid their dividend or increased their dividends 45 years or more. Okay, not 45, sorry, 25 years or more. 50 or more that's when they become dividend kings. Payout ratio only 44%. You know, dividend safety is 99%. And then when you look at their free cash flow, okay, you can see why that is the case. Okay, so you've got $5.77% and $7 billion in the bank that they can use to buy back shares, to pay you dividend and so on. The beta is quite low as well. Profit margin of almost 15%. Return on equity is not great, but it is better, almost a double digit. It's not great, but I would say it's okay. I wouldn't mind that at all. 10%, I normally look for 15, but sometimes I accept about 10. Okay, so this is almost 10%, so that's fine. I own the stock for this company, so I'll show you in a second. Future growth about 9%, and then dividend. In terms of overvalued, it's really undervalued at the moment, 18%, and you can see the price target is 128 and currently is $104 per share. According to Morningstar, and it's a buy at the same time. According to Morningstar, it's a 18% discounted at the moment, and the price should be $129 per share. Now, just for transparency, I do own shares of Medtronics. Here we go. Okay, I own 10 shares of this company. I'm planning to add to this more in the next few weeks. I do on Microsoft. I'm definitely planning to add to Visa. Definitely planning to add to, because it's actually down. Now, when I say add to, I'm not saying right now, but I might be adding to Visa maybe in the probably next month, and see how this month goes. And because there are a couple of other businesses that I'm basically building up basically right now, so I'll focus more on that, but I will definitely add to it. There you go, there you have it. So that's the 5 different stocks that you could potentially add to your portfolio if you don't own them already. And one of the things that we really need to start thinking about more of is now thinking about the future, thinking about the long term, and stop looking at the stock market on daily basis. I do, because I really enjoy. It's weird, okay, but I don't get the urge to actually sell. Okay, the only time I sell is when I've actually done my research. I don't sell anything until I have a reason why. Okay, I always talk to about it to friends and things like that. I just basically have a target prices. Oh, it's changed because the market's about to open. But yeah, so when you look at this week and you see this, you like start freaking out. People like 9%. Look, and what's it called? Broadcom. It's almost 10% down just this week. Okay, I have a target price. So there are a couple of companies, Qualcomm and Broadcom. I'm waiting for them to pull back to a certain price. Then I'm definitely going to buy TSM. Look at it, 10% down since that we spoke about it a couple of weeks ago. So yeah, it's just a crazy market right now. Just be patient with yourself. Just buy when you can and what you can, InshaAllah, and do your research. Don't get into the high tech companies that if you don't know their future and what it looks like at the moment. Focus on blue chip companies that possibly pay some sort of a dividend. Okay, maybe focus on healthcare, maybe focus on consumer staples. Okay, the tech companies, the Microsofts and so on, the ones that you know are going to be around for a long time. Maybe look at the materials. Okay, PPG is a stock that I own. I kind of neglected it for a long time. It pulled back of almost 10% in the last few weeks, so I bought more yesterday for that reason, and I'm planning to add to more because I haven't had the opportunity. So yeah, just to have your buy target. So I've always have target of what I'm buying when I'm buying. So anyway, I'm gonna stop there. I hope you doing well, inshallah. Take care, everybody. Assalamu Alaikum.